Does anyone have any recommendations for educational resources, books, podcasts, courses, etc., for how to vet the operator and the deal itself? So I'm not going to give resources. I'm just going to be the resource and try to talk about some of the things that I think you should look for if you're going to be a passive investor. The biggest thing for me is you don't want to only underwrite the deal itself. You want to underwrite the person operating the deal. A deal is only as good as the person that's operating behind it. And the biggest way to underwrite somebody that's doing it is to take a look at their track record. Have they bought deals? How many deals have they bought? Have they sold deals? Right? Just because anybody can go out and buy a deal, right? Just because a deal is on the market, and just because you have the money, if it's a 6 cap market, I can buy any deal for a 2 cap. So I could go buy 30,000 units tomorrow if I wanted to, just pay double what everything's worth. So just because somebody has bought a lot of deals doesn't mean they're a good operator. So understanding what their track record is, how did they operate? How did they operate against their projected budget, right? Did they come in line with their projections on income? Did they come in line with their projections on expenses? If they didn't, why didn't they, right? Oftentimes we have deals that, we might be low on income or, high on expenses or vice versa, or a combination of the two, but there's a very good reason for it. One of our deals that we did very well on, we were super low on expenses. So all we did was, instead of continuing a renovation plan, we continued to implement the RUBS, and we just kept occupancy super high. We didn't need to push income because our NOI was there, and it served 2 purposes. One, we hit our NOI threshold, which we thought would make us a really good return. And 2, because we knew we could probably push income a little bit more, it protected us in the future for cap rate movement in, a softening market. If there's a ton of meat on the bones, someone is going to continue to pay low cap rates despite what the market is doing. So, we just continued to analyze where the market was going and how this deal was doing. Instead of really trying to push and take a risk and a gamble, we kept occupancy really high at 97, 98%. So if somebody saw that deal as, verifying us as operators or sponsors, you might say, well, you guys missed on income, but that was conscious. That was something we decided to change because we felt it would still work. Some other things I would look for is the assumptions people are doing when they're underwriting. A big one is comparing the actual expenses for the prior year or prior 2 years versus what they're doing going forward. A big one is taxes. Understand what is happening with taxes. A lot of places will reassess on sale, but some won't, or some have a significantly smaller reassessment. Some have a significantly bigger, like Columbus, Ohio. People just get, brutalized on new acquisitions because they go to 100% of reassessment instead of like 60, 70, or 80. So it swings way higher. Some places like North Carolina, they do it every, I think it's 4 or 7 years. I forget exactly. So it may have just been reassessed and you've got another 6 years until it goes up. So I want to look in year 6 or year 7, I guess, year 6, whatever it is, and make sure that the taxes are going up and that I understand what level they're going to. So that's a big one. If they're cutting expenses, right? If, let's say, repairs and maintenance was $100,000 and they're dropping it to $80,000, why is that happening? They should have a reason for that. It shouldn't just be, well, that's the market. Well, yes, but, in the market, there's some that are high and then there's some that are low. So you got to understand, is this just one of those ones that operates highly because it was built poorly, right? Going back to what we were talking about, building a property and really knowing it. This deal just could have been built very poorly and needs more repairs. Just if anything is cut, they should have a really good explanation for it. If they just said, well, this is the market, that's for me, not a good enough reason. Other things I would look for is, percent increases on assumptions. Every year we'll assume that income and expenses are going to go up X percent. So inflation, we usually say, is 2%. But if we're in a market, like the Floridas, we may assume 3 for income, 3 for expenses, 2.5 for expenses. And the reason for that is because there's a lot of job, wage, population growth. The past 2 years, it's been something more like 5-6% per year, but we've only underwritten to 3. So we've actually gotten additional rent growth than what we projected. So, taking a look at what those are, and if it's not provided, do the math and figure it out yourself. If somebody's got 6% growth for the next 7 years, that's probably not happening. It may not want to be a deal you're going to do. I would ask for, what does it look like at 2, or at 3, or at 4, and just seeing how you feel. Other things I would look for is the cap rate that they're selling at versus the market today, or what they're buying it at. If somebody's buying at a 7 cap and they're selling at a 5.5 cap in 3 years, I would be very leery of that deal. Unless the market is a 4.5 cap and they're just getting a crazy stupid deal, well, then that makes more sense. We always look for deals that bake in some conservatism in the cap rate. So if the market today is a 5.5, don't underwrite to a 5.5, because if the market shifts in 3 years, you're going to be stuck holding the bag and you're not going to hit your return. So underwrite to 5 3/4, a 6, 6 1/4, 6.5, whatever makes you feel comfortable. I would look for CapEx budget. I personally like to put in a contingency just in case, things happen, things come up. You want to have additional capital needed. The other biggest thing that I didn't mention, when you are investing with somebody else and you are giving up control in that deal, one of the most paramount things I would look for in an operator, in a syndicator, is their co-investment. Are they putting their money where their mouth is? Are they having skin in the game? Because if that deal does not go as planned, somebody with no money in that deal is not going to work nearly as hard as if they're investing 5, 10, 15, 20% of the equity. And I would also look at, typically deals will have an acquisition fee. Are they investing above and beyond what that acquisition fee is? Or are they just rolling all that money into it and really it's, they're getting compensated with equity and it's not really skin in the game. It's fake skin in the game, whatever you want to call it. So that's another thing I would really look at. Does this person have skin in the game? Are they going to work hard for their money as well as mine? Are our interests really aligned is what you're really looking for. When you are investing with someone as a syndicator, an operator, fund manager, whatever, the closer you can take your interests and their interests and put them together, the better off that investment is probably going to go, because people just work for their interests. That's how it works. If you do not have money in a deal and it's going sideways, it just flat out fucking sucks. So those are some of the things that I would look for if it was me.